All right. Welcome back to capitalcompetent.com. Today we're going to go over a very important topic. Are there any good buys today in the stock market? Okay, we're going to evaluate exactly what's going on so that you can get a better understanding on becoming a genuine investor and not a speculator. Okay, there's so much noise out there with everything that's going on with this rally, with Trump's litigation, with the bond markets. But at the end of the day, right, business is all about money. That's all it is. All a business is money in. So we're going to value that. The importance of valuation. Okay, income streams are extremely valuable. If you work a job, right, you are getting a piece of an income stream. You are an employee to an income stream. If you are the owner of that income stream and you have control of the income stream, that is extremely valuable. Okay? If you could quit your job and just manage a company that gives you $100,000 a year, that is extremely valuable. You will do that 9 times out of 10, unless you already have a job that you absolutely love and you don't want to let go of that. But even at that point, right? Now, these income streams take forever to build because you have to form relationships, you have to get customers, you have to build trust, you have to have a superior product, right? The marketplace is competitive. They take a long time to build. So if someone is not in that position where they are making that 100,000, and this is important. This is important. I'm going to relate it to stocks in a little bit, but this is fundamental view of business. Okay, and my business, it's not a very big business, right? But it's big for my age and how much I run it, right? It took me multiple years to build. Okay, if someone was making this $100,000 a year, what do you think they would sell that to you for? If it took him 10 years to build this income stream and he's happy with his 100,000 and he likes it, you will likely have to pay him 10 times, 15 times for him to sell it to you. And that is a reasonable multiple. He is likely not going to sell that to you for less, okay? Because it takes so much time to build up, and he wouldn't sell it to you for $100,000 because he'll just wait a year. He'll get 100,000. He's not going to sell it to you for $500,000 because he'll just wait 5 years, right? It's got to be a substantial amount in the future where it is worth his time, okay? That is on the seller's side, right? Now, how this relates. When you enter the stock market, you are a buyer, okay? It's all about money. That's all a business is money in. You want to get that $100,000 a year for as little cost as possible, okay? If you pay $1 million, let's say you got that seller and you pay $1 million, it'll take you 10 years to return the capital you invested. That's a really good yield. However, the more you pay and the higher the multiple is, the less your return is, and it's not nearly as attractive. Okay? If I could get a $100,000 revenue stream for 10x the earnings, that is a miles better deal than 20x. Okay? Because the return on my capital is a lot higher. And everything is about earnings. Everything that's going on right now is all about price action and buying. It's not about underlying earnings. And with everything going on, you want to make sure that you are buying good quality companies. Stock market today, okay? You want to be a smart buyer. Like I said, time and time again, but business is just money in. That is it. That is it. Okay? If I start a business, let's say I start a business selling window installation. Okay, I will come and install a window for you if you give me money. That is my business. So the business is just money in. I will not install that window for you unless I you pay for the materials and you pay for my services. It's just money in. It matters how much you pay for this business. You look at these valuations today. Apple is a $3 trillion company trading at 31 times earnings. Nvidia is $3.28 trillion. I mean, that is huge, and it's trading at 44 times. Tesla, a car company, is trading 1.1 trillion 200 times. If we relate these multiples back to businesses, okay, if each of these companies I just listed was that $100,000 a year you wanted to buy, we're relating it back to that, you would have to give Apple $3 million. You would have to give NVIDIA $4.4 million for that revenue stream. You would have to give Tesla almost $20 million. Do you honestly want to pay that much? Is that a sound investment? Okay. Now, that being said, I'm going to go into why multiples, some companies should have higher multiples. Okay. Some multiples deserve to be higher. Okay. If that $100,000 a year keeps growing each year, that multiple should be higher. Okay. But there are three types of companies in the market. You have mature and established companies, you have scaling and growing companies, and you have discovery market introduction companies. As the company moves up the ladder, the market cap would get higher, and the PE should stabilize more to that 15 to 20 range. Okay? When you are looking at companies that have the highest market caps in the world, it is extremely hard to grow into that market cap or grow that market cap higher. Okay? When you are looking at Apple, it is a mature, established company. They sell over 200 million iPhones a year. For them to keep growing, the iPhone market is saturated. For them to keep growing, they have to establish a new company under them in this discovery market introduction. That's how Apple grows. They'll come out with AirPods, right? And then it's very easy for them to hit this, and then that essentially will go into this business. Okay? However, when they are at 3 trillion, trading at over 30 times PE, it gets harder and harder and harder for the earnings to justify the higher price. Now, these multiples get so high because the demand for their stock is so high. Okay, it's not the underlying business that's driving the stock prices right now. It is the abundance of buyers. Okay, it is all price action. When you, and ETF inflows, I will admit, the ETFs boost up these high companies because they're considered mature and established. Okay, so that can go into a higher multiple. But 30 for Apple is too high. 44 for Nvidia is too high. 200 for Tesla is unbelievably high. Okay, let me move on to the other slide. The Mag 7 is too expensive. The market is basically saying you must pay at least $3 million for that $100 a year. Okay? There are still good buys out there. They just aren't popular. When you're looking at it today, it's what's popular that rises in price, but that is not sustainable. Okay? When something is lifted only by price action, that could flip in an instant. Okay? If there's a high demand and high buying volume, prices will rise. But there becomes a disconnect with what the business is actually worth and how much you are paying for that business. The more you pay for that income stream, the more you are hurt in the long run. If I pay $12 million, if I pay $20 million for that 100,000, that 100,000 better be 200,000, 300,000, 400,000, 500,000. Okay? It has to be. Today's market valuation. I'm going to go over some good buys. Pepsi, $19 priced earnings with a 4% dividend yield. It's an established business, right? Their brands are unmatched. Okay. Their rival is Coca-Cola. That's it. Google, 18 priced earnings with search dominance and AI and competing with Tesla in the self-driving. They're already ahead of Tesla. Target, 10 PE. Okay, it's been beaten up because they seem like it can't compete with with Walmart and Amazon. But Target is still a great company. Everyone I know shops at Target. They prefer Target over Walmart. It's just not popular. Pfizer, okay, they've been around since 1850. They have a 7 forward PE, which means their forecast for next year is only 7 times. So that means I'm paying $700,000 for a $100,000 income stream with a 7% dividend yield. Tell me how that's not a good buy. Let's go into risky buys. Tesla has a $1.1 trillion market cap with a 200 price to earnings and an unproven business model with their robots and with their robotaxis. If you want to watch my Tesla video, please do, because it takes down actual numbers on how in the world is Tesla going to make money with this robotaxi? How in the world are they going to make money with their robots? It is a car company. It's a high-tech car company, so it should have a higher multiple, right? Because there is growth in that. But this right here is unbelievable. Unbelievable. And it's honestly unreasonable. And honestly, it's not smart. Okay? Palantir, $300 billion market cap with 500 PE. 500. That means I would have to pay $50 million to get that 100. I'm bringing it all back to that. I'm bringing it all back to that scenario where there's 100. That 100, we want that $100,000. We want that $100,000 income stream. But how much are you going to pay for it? Because at the end of the day, it's all money. We all make the same. We're all trying to compete for the money supply. Nvidia, one of the largest companies in the world, with a $3.28 trillion market cap, trading for 44 times P. Let me break this down, okay? And notice how I say risky buys, not bad companies. These are amazing companies, but they're just too expensive. Are Tesla, Palantir, and Nvidia bad companies? Absolutely not. They are fantastic companies. They are just bad buys. When you get into these extremely high valuations, like of 100 billion plus, and especially in a multi-trillion-dollar market, it comes harder and harder to grow. There's not much that they can invest in that will result in growth. With the 200 PE of Tesla, they have to 5.5x their profit next year to justify today's prices. Palantir has to 21x. Nvidia, one of the largest companies in the world, has to 2x their earnings next year to justify today's possible. How is this possible? Genuinely, watch the Tesla video where I break down actual numbers of cost and how will that make money. At the end of the day, businesses is just money in. How is a robotaxi going to make money? If they have to build the car, have the software, they have to build the car, insure the car for damages and all that, and then they have to compete with Uber, who does not have to own the car. All they have to do is pay someone, and they take on all the risk. How is that going to make? Watch that Tesla video and let me know what you think. Seriously, like, watch it and fully understand it and let me know what you think. And let me know if I'm wrong. Let me know if I'm wrong. Okay? There are good buys, but they are just not popular. We are all competing for higher returns, higher and higher returns. When your neighbor invests in Palantir and they 10x their money, you're going to want to buy in Palantir. And you're going to pay those high premiums, but you're paying way too much for that $100,000 just because you look at your neighbor who's not as smart as you, but you see them with more money than you. Of course, you're going to want to buy it. But I'm telling you, that is not how you invest. It can flip in an instant. In 6 months from now, I guarantee you Tesla's going to be lower. I guarantee you Palantir is going to be lower. I guarantee you Nvidia is going to be lower. If I'm wrong, hey, you can leave all the hate you want in the comment. If I'm wrong, okay. Thanks for watching. Leave a like and subscribe if you want to hear from me more. Okay, weekly updates on my portfolio. Check out the portfolio. I'm growing a portfolio in front of your eyes. I can show you how I go from 1K to 10K in 1 year. I'll show you good quality, sound advice, but I can't give you advice. I can just educate you. Okay, this is all educational purposes. I can't give you advice. I can just show you how I do it, and then you have to make the decision from your own. Okay, let me know what you think of this. Am I wrong? Are there any good buys? Let me know. Watch that Tesla video. Let me know. Thanks. See you next time.